Good evening, everyone. Time for another member update. This is the gold spot 4-hour chart, and I want to point out a couple of things on this. So the big question is going to be, is this little rally over? Is this just a flash in the pan? First thing I want you to notice is going to be this support level. You can see it's right there. And we do have kind of a pullback right to support, and then we're starting to rally. The other big thing to notice is that the MACD is resetting. Now, I've covered before the way you use the MACD. The MACD is really not a useful indicator in a sideways market. It's really only a useful indicator in a trending market. Now, the question is this market starting to trend upward? In a market that's trending upward, you'll find that the buy signals are valid and the sell signals are not valid. Same thing in a downtrending market, except the opposite. So the way you can try to figure it out, it's hard, especially in a market that's changing right here. So you can see buy signal was given there and sell signal was given there. So you can see that the buy signal was more valid than the sell signal. Another buy signal given here, a sell signal given here, then this sell signal was more valid. So we're getting up to the present time here. You can see that we got a sell signal with that top there. Then we got a buy signal here, and that was a big rally on that buy signal. Now we've reset all the way back down to here on the MACD. And that's a big reset. You can see this goes all the way back to July, but we've already reset back on the MACD. So if this is the case, if this market is rolling over, then this buy signal we're at right now, this is going to be a big buy signal. We're going to go up from here very, very dramatically. That's going to be the big indicator to you that this is a market turn and that we have now moved into a trending market on the upside, where let's go out on the weekly to look at those, where the buy signals are valid and the sell signals are not valid. So just to look on the long term, you can see there's your buy signal. That was a valid signal. This sell signal, not really. Kind of went sideways and broke out again. Got another sell signal there. That wasn't a very good signal, but this buy signal here was really good. This buy signal was really good. Look at the run we got. Then we got this sell signal, and that sell signal was a good signal because it was followed by a buy here with a weak rally, another sell. So the question is, are we going back into this sort of an uptrend where the buy signals are valid and the sell signals are invalid, or will this downtrend continue? And I think this area is going to tell us. It's not going to be too much longer before we know. Also, you can note here that on the weekly we are crossing over to the positive on this MACD. As far as the monthly goes, and the reason why we're looking at gold, of course, is that gold leads silver. You can see that we have a severely depressed MACD on the monthly. Something like is unprecedented, but you can see that it has crossed to the positive, but it has a long ways to run to cross the zero line. Probably needs to even get into new highs just to cross the zero line. So if I'm right that the buy signals are starting to be valid, then you're going to see some very dramatic price moves soon. So I wanted to talk about interest rates and negative interest rates and where we are in the scheme of things. But before I look at the charts and go into the details of it, I wanted to have you listen to a little bit of this interview with Jimmy Rogers. It's a new hedge fund channel. I think this is the first interview on this channel. Macro Voices. I'm not sure who this hedge fund manager is, but he's pretty good. This is a smart guy. Macro Voices, and he has Jimmy Rogers as the first interview. So let's listen to Jimmy for a little bit here.
Handouts, that kind of thing. Do you think that's a possibility in this presidential election year? Well, I know what will happen is that as the markets get worse, Mrs. Yellen and the people in Washington are going to get a lot of phone calls saying you've got to save civilization because the world is coming to an end. And they're bureaucrats and academics. They don't know anything. That's why they work for the government. They're going to panic and do something. They're going to have to do more than they did in the past because it didn't work in the past. So sure, they may send us all a check. Who knows what they're going to do coming down the road because it's going to get worse, and they've shot a lot of bullets. A lot of bullets have turned out to be blanks, and now we're going to be faced with a much worse problem. And it's a presidential election year. You're right.
A lot of people are getting worried about the possibility of another major stock market crash like 2008. And I think that's very possible myself. We may be seeing the beginnings of it now. But frankly, if I think about the long term macro picture, when I think about the word bubble, my mind goes straight to the bond market, not the stock market. I kind of feel like we're approaching a peak debt moment where maybe finally we wake up and recognize what you and I know, which is a lot of the outstanding debt in the world will never be repaid because it was malinvestment that never should have been made in the first place. If I'm right, that could potentially lead to an epic crisis in the bond markets in coming years, both corporate and sovereign credits. And maybe even a debt jubilee, as some people have started to suggest. The treasury bond markets around the globe already feel toppy to me. We're seeing, at this point, negative interest rates in German bond yields well beyond 10-year maturities. We seem to be at the end of a 30-year bull market in bonds. Sovereign bonds are still feeling like they're toppy, maybe headed a little higher, but the corporates, particularly the high-yield junk bonds, are selling off pretty hard. Is this the beginning of the end, Jim? Is the bond market bubble ending? Or is this sell-off in high yield just a little bit of noise that doesn't mean anything?
One small correction. The bond bull market has been going on 35 years. It started, the bottom was in September of 1981. So it's been going on over 34 years now. And yes, it's coming to an end. You may have government bonds go higher for a while, just as the panic takes place. I'm short, in the terms of full disclosure, I am short junk bonds in the United States. And you're right, they are going down now, some of them more than others, obviously. But no, we're making a top in interest rates. That does not mean, Eric, that if and when the Federal Reserve panics again, that interest rates won't go down some more, bonds go up, in other words. But no, we're making the top. There's very little question, we're making the top. I'm not short sovereigns because I expect so much panic that many people will pile into them like they're piled into the U.S. dollar. But I'm certainly short junk bonds, and I wouldn't buy bonds with, I can't imagine, unless it's a very special situation bond. I can't imagine buying bonds anywhere in the world.
So let's take a look at some of these bonds. There's other parts of this interview where he talks about, and I just wanted to point out here that Jimmy Rogers has never been a conspiracy theorist. Is that because he's from Cambridge and is connected to Soros? I don't think so. I think Jimmy says what he thinks. He's probably not allowed to say some things for fear of being bumped off. But I think he's an honest guy. I don't think that the wealth came from Soros. If you go back and study the books and the interviews, the wealth actually came from the ideas that Rogers had. Soros was just simply the trader. He executed the trades that Rogers picked. But so I do trust Jimmy Rogers. I don't think he can say everything that he thinks. But let's look at these sovereign bonds. I think this is very interesting when we look at the bond market here. We're going to look at the national debt clock to see what impact that's ultimately going to have. But let's take a look here at the bonds. Now, this is the 30-year Treasury bond. And you can see here, there were many times when we thought that this chart had gone parabolic. And if you understand the nature of parabolic charts, it's very difficult to pick a top in a parabola because it can always accelerate higher. For example, in the last financial crisis, you can see here, a lot of people would have said that this parabolic move, you can see it starts to curve up there. That was the top. But you can see we hit 140 on the long bond. That's the 30-year. And with the money printing that they came out with, bonds rally. Now, that's very counterintuitive for most people. because when I say the money printing that they did, most people would say, well, if they did a bunch of money printing, then that would obviously be bearish for bonds, because that would mean that that's an indicator of future inflation, and we would expect the bonds to sell off. That is true in a classical sense, except when you think about the fact that these are manipulated markets, and that a tremendous amount of the money printing that was done was actually money printed to buy bonds. So if the money that they printed went into the bond market, then we're actually going to see debt go up and interest rates go down. Now that's what we're seeing again. So you can see that parabolic top that appeared to be the case back there wasn't. We also had another one in 2012 right here. And that wasn't the top. We got another parabolic spike, and this one here, you can see just the most recent week. This is a weekly chart. This is after. Let's zoom in here and show you. This current weekly spike, you see that? That's one of the largest spikes we've ever had in the price of 30-year bonds. That spike is in this new year. This is after the Federal Reserve lowered interest rates, and we can see that the price of bonds are spiking. They're skyrocketing. So the price of the long bond is actually going the opposite direction. Now, if we go and look at the price of euro dollars, we don't have T-bills anymore because they discontinued the series, but we can pull up as a proxy for the T-bills, we can pull up the 3-month euro dollars, and you can see the beginning of a rolling over there with the short-term interest rates starting to rise. You can see the price of the 3-month treasury essentially starting to roll over, and you can see how long that time period was. It was a tremendously long time period where once the money printing happened there in 09, then they got to that near zero interest rate, and it just stayed pegged there until it started to roll over. So that's the shortest term. We looked at the longest term, we looked at the shortest term. So let's go and go further out in the yield curve. You can see this is the 5-year note, and you can see we're seeing a rally. It's not into new highs like the 30-year, but interest rates are falling on the 5-year note. And if we pull up the 10-year note, that one is close to going into new highs. So interest rates are falling. That is a continuation of the pattern that we've seen. As Jimmy Rogers pointed out, long in the tooth is an understatement when we talk about this bond bull market. This bond bull market has gone on since 1981, and you can see the current section of it is entering parabolic territory. So let's go over to the national debt clock. I wanted to point out a couple of things to you here. Now, we've covered this a lot, but one thing I wanted to point out here is that this is something I always point out, is the federal budget deficit. This is roughly 50% of what the real deficit is. This is how they do it. Now, someone could argue that, well, that's so far this year. Well, that would be disingenuous because everything else is on a rolling 1-year period. So, but really the deficit is somewhere around 800 billion, probably close to 1 trillion. Now, we know that under President Bush, the national debt doubled. It went from 4 trillion to 8 trillion, 9 trillion. We know that under Obama, it has already doubled, 10 trillion to 19 trillion. So we're looking for, if we have another 8-year term on the next president, we're looking for a $40 trillion debt. What the deficit will be, who knows? Maybe 3 trillion a year. But I wanted to bring you over to these figures over here and have you take note before I go into the details here. You can see here we've got U.S. population, that's 323 million, and then you can see the last number is 996. And I want you to look over here at total receiving benefits, and that's 93. So we've got 96 over here and 93 over there. So you can see we just ticked up to 97 and 94. So the thing I want you to keep an eye on is which is growing faster. The number of people who are in the population or the number of people who are getting benefits. So we'll come back to that in a second. Now, let's do the simple math here. We can take this number of the U.S. population and divide that by 2. So let's take 319,019,999 divided by 2. And you can see that the number we get is 161,509. And you look at our number down here is 161,098. So if we do that another way and take 161,098 and divide that by 323,020, you can see we're at 49.8%. So that is how close we are to this tipping point. The tipping point where there's a larger number of people who are receiving benefits, who are actually living off the work of others than the total population. Now, when we go in and look at things like taxpayers or private sector jobs, we know that the cart is already tipped very, very dramatically. But you can see we're coming towards this turning point here. And to show you how dramatic this is, remember the number I showed you before? We were at something 6 and something 3. You can see now we're ticking to where we're at 2. Okay, so just looking at the raw numbers now, just based on statistics, you know that if you have a large number and you have exactly half that number, and both of those gain at the same rate, you know that this will become a larger and larger percentage of that. But not only are we seeing that, but it's actually worse. This number, the number as a total that are receiving benefits, is actually rising faster than the population. That is a recipe for complete disaster. That's a recipe for utter bankruptcy. And I think that's what we're going to. I think that's what Jimmy Rogers knows is coming. And I think that ultimately that's what the gold market knows is coming. We know they're already talking about negative interest rates. And negative interest rates are penalizing people who hold basically anybody that's a saver. If you save money in dollars and you keep them in your bank account, or if you save dollars and you keep them in your mattress, then once interest rates go negative, the people who keep their dollars in their mattress are actually performing better than those who keep their money in the bank. So we know that as interest rates begin to go negative, then there's a tremendous incentive for people who have cash balances to pull their cash out of the bank and put it in the mattress. That's why we're seeing the push in some of the European countries now, and there are hints at it in the United States, that they want to go cashless. They want to ban cash, and that makes perfect sense because as interest rates go negative, people will begin to withdraw their cash from the banks and keep it in their mattress, and they want to stop that from happening. So a necessary corollary of negative interest rates is going to be the banning of cash. Now, I don't think that either is wise. I don't think it's wise to keep a large cash balance in your bank account. and I don't think it's wise to keep a large cash balance in your mattress. So I don't think I'm the only person who realizes this. I think that a large number of people realize that and are going to realize that. And when this comes to pass, and I think it's going to come to pass, when the Fed panics the next time, then we'll go into negative interest rates. That's their next bag or next rabbit they have to pull out of their hat, the next bag of tricks. Then when it goes negative interest rates, it's also going to go along with a ban on cash, or at least a severe restriction on cash. And that is going to be tremendously bullish for physical gold and silver and for cryptocurrencies. So that's what I believe is coming next. We're looking at negative interest rates, a ban on cash, and then an explosion in the price of the precious metals and cryptocurrencies. And we'll talk to you next time.